Hey everybody, how you doing? This is Matt with Real Talk with Matt, and I have an exciting product I want to share with everybody. First, I want to say I'm happy to be back in Florida. I had a great vacation last week, and I'm sorry I have not had content out there, but every once in a while you need a little break. So, with that being said, today we're going to be talking about fix and flips. We're going to be talking about rehab loans, how you can renovate homes and sell them for a major profit. I'll even give you an example for one of my clients we're working on now, trying to get the contract solidified. So if you've been watching the market lately, you probably noticed something interesting. Home prices have come down in a lot of areas throughout the United States. And when that happens, opportunity shows up. This is actually the part of the market where investors start paying attention again, not because it's risky, but because the numbers finally make sense. And I think over the last couple of years, with higher interest rates and higher prices, that definitely deterred a lot of people from going into fix and flips and buying investment properties. Where now it's a healthier market where prices have come down, rates have come down, but there's also a bigger market out there when people are trying to sell their homes that are super outdated and keeping that value low, where an investor might want to come in and fix, flip, rehab, sell it, and make good margins. So we're going to talk about that today. It's going to be a very high level overview. Not going to keep it complicated. I'm going to try to make it as easy as possible. And if you're interested in learning more about this, you could always reach out to me. I have a great team that analyzes these deals and make sure it happens. And we'll show you a live sample of one that we're working on right now today. So it's really, really important to understand that, with the prices being what they're at, this is where the margins come in. That's exactly what fix and flip investing is all about. This isn't HGTV, but it can be very profitable if you understand the process. So, who is this for? I want to be clear, this isn't just for people who've done 10 flips already. A lot of the conversations I'm having right now are with first time investors, people who've owned rental properties but never flipped a home, or folks who found a great deal and don't know how to fund it. And the biggest thing holding them back isn't money, it's not understanding the entire process. You don't need to know everything when it comes to doing these things. You just need to understand the steps, which we're going to talk about. But I'll give you some examples. I've helped a lot of people over the last few years buy DSCR loans for rental properties, but they want to do work to it. I've had a lot of people buy investment properties and then pay out of pocket for all the rehab. Well, that's great from one perspective, but at the end of the day, you cannot scale up your business if all your money is tied into a property until you sell it, right? This is where if you're an investor out there or somebody who likes to do ground up construction for investments, wants to find a great deal on a home and put some money into it and then flip it, an easier way to scale your portfolio is to use less of your cash. And that's where this comes into play, where in some instances you could do as low as 15% loan to cost. So you got to really start thinking about it. If you're putting 20% down, 25% down, nonetheless, if you're paying cash, that money is gone. It's parked, right? So my goal today is to help you understand what the process is like, if this is the right process for you, and how we could work together to get you the best possible deal and make a lot of money doing it. So that's what we're going to be talking about today. So we're going to talk about the big picture, how they work, right? So fix and flip is pretty straightforward at a high level. You find a property price low, price hopefully lower, um, and below its potential, and you renovate it to today's standards. So, for example, in Florida, you might find a lot of houses that have old tile floors, old fixtures, looks like the 70s, and different things like that. Well, it, if you can find a property like that that's priced good or make a good deal on it, it might not take you much to get it up to speed and up to today's standards to make a good profit on it, right? And the whole goal here is you renovate it to today's standards, you resell it at market value. You capture the spread between the total cost and the final price. That spread, that margin is where you or an investor makes the money. The money isn't just made in the renovation, it's made in the purchase. So it's really, really important when you start looking at properties. Um, what is the margin? What is the ARV? What we call after repair value. All right. And we'll talk more about this, but typically what lenders want to see is a 70% ARV. Okay, between the total cost and the sale price, they want it to be at about 70%. That gives a good margin there, right? And also helps protect the lender so they're not investing foolishly and then all of a sudden you can't sell the property. So those are key things to keep in mind. So when you're looking at purchase prices and all that different stuff, it's really, really important to really analyze the market, right? Analyze that specific property and coming at a good price that's not going to insult somebody either. So those are the checks and balances that you need to find in order to make it work. The cool thing is, I actually have a couple forms for anybody to fill out. Has your track record, right? So the more homes you've done in your lifetime, they're going to verify it, but it puts you in different tiers, right? So if you only done one, that's going to put you in a lower grade tier than somebody who's done 10, 15, 20, or 30. So those are things to keep in mind when doing these. But once I have a track record, I got it saved and then we don't have to redo it again. We just add to it. But then the second part comes in is identifying a property. So if you identify a property, it's really important that you work with me and my account manager with my lender that does these. So we could see and kind of verify that, all right, with your construction plan, is it going to make sense? Because you could go on the internet and have a bunch of people say, oh, you only got to put 10% loan to cost, da, 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 and they don't go into the legwork. Well, guess what? You get halfway through the process and it doesn't work. And that's our goal here is to make sure that it always works. And then as you do more business with us, your funding time becomes faster. So the first deal is probably two, maybe 2.5 weeks. And then deals after that might only take 7 business days. So those are things that you got to keep in mind, which makes it a lot more beneficial if you could go to a buyer or a seller and say, hey, listen, I want to buy this property. This is our plan. Close in 21 days. Here we go. No contingencies, right? Unless the appraisal on the ARV after the construction doesn't match up, that would be the only way that it wouldn't work, or you could put more money down to make it work. So let's talk a little bit about finding the right property. This is where the beginners lean in. Good flips usually have a few things in common. They're dated, but they're not destroyed, right? So you got to think about it. They're dated, but not destroyed. When you have a house that's destroyed, well, that's more work that gets involved and more things that you need to do that cost money that go into your ARV. You want to look at certain things. So if the house was built in the 70s, have they upgraded it throughout the process? If not, that could be a good thing because fixtures and updating a home with, LVP flooring, da 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 da, isn't really that big of a deal. But if you find a home that's just totally, in shit box, well, guess what? Then you're probably taking down walls, redoing drywall, reformatting the whole house. And then that costs a lot of money, which goes into your margins. So that's something very important. You also want to look in solid neighborhoods. That's important for resale, right? Because you're on a 12-month interest only loan. You got to have an exit strategy. And the exit strategy is that you get the work done within that process. So if you're newer to this, you may want a GC to make sure everything's on time. If you try to do it yourself, it's going to be probably more difficult. If you have a lot of experience, this is going to be an easy process for you with quick draws and all the good things that you don't need to worry about. But those are two important things. They're only dated, they're not destroyed, and they're in solid neighborhoods. But I will tell you, and I'll tell a story a little bit later about one I did a couple years ago, which blew my mind how great it was. But a really good example of a semi-destroyed home and how much value it being updated and fixed really increased. So um, you also want to find a home. So it's like a puzzle, right? You want to find a home where the layout makes sense. All right. A lot of these older homes, the layouts don't necessarily make sense. They're very boxed in, closed out. So you want to have a good vision. You want to have a good vision of what you're envisioning on the work that needs to be done and put that into fruition, right? You want to start thinking, okay, if we need to knock down that wall, what does that look like? Um, Obviously, there's a lot of technology out there like ChatGPT and different things. Actually, the one that we're working on, the whole entire construction plan was built through ChatGPT, obviously with a touch, but it makes it a lot easier than having to go in there and try to figure out, all right, lumber is this times blah, 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 blah. It kind of does the stuff for you. But most importantly, got to make sure the numbers work, right? I had one scenario, it was really tight. And at the end of the day, we went into the situation saying it's not a good fit, right? numbers were too tight. There was too little margin to move forward. And if the appraisal came back short, it would have exploded the deal. So if you have a fancy touch to certain things, well, that could impact how your ARV stands too. So what's the after repair value? If you're spending all this crazy money on certain things where you might need to cut down a little bit, cut back a little bit, right? To make these deals work. But those are all things we help you with too. But this is where the most people get tripped up because they fall in love with the property before they do the math. All right. It's not your property. You're not keeping the property. Your goal is to sell the property and make money. So take your emotions out of it. It just has to make sense so it works. A great looking house can be a terrible investment. So those are things you got to start thinking of. But how I build the deal, so ARV explained simply. So this is where I come in with those things and my partner at the lender comes in these things. Before we even talk about loans, I work directly with the lender to pull real comps. Okay. So Zillow is a good example because it's always updated. We take the spectrum of where you're buying, pull it out, see what's closed in the last 6 months. And we got to try to figure out like where we're going to end up with the construction and everything else. Does that have the same amount of square footage? Does that have the same amount of bathrooms? Bedrooms, all those different things go into factor. But we got to also look at what renovated homes are actually selling for. So the updated one versus a non-updated one, those are important things. But we have to measure what the property could be worth and should be worth after these repairs. And that future value is called ARV. And you probably heard that me say it a bunch of times, ARV. It stands for after repair value. So the ARV drives everything, how much you could borrow, how much rehab makes sense, and whether the deal is worth doing at all. ARV isn't Zillow, it's real sales data. Okay. Those are important things to keep in mind. And you always want to have that 70% margin. For example, if you're buying a house at $500,000, you need to do a $200,000 rehab. That's a total loan of $700,000. That means that house needs to sell for a minimum with comp supporting it for what? $1 million, 70%. Okay. That's how that works. If your ARV is lower than what the sale price will be, well, guess what? That's where the fund comes in. You can start rolling in your interest only payments during the course of the loan, have it deferred. A lot of the costs can be deferred or rolled into the loan balance. So that's where you could essentially do it with your loan to cost down payment and not have to make any payments, therefore. So a lot of great things there. So let's talk a little bit about the financing and the process. So fix and flip loans are built around the deal, not your job. We don't care about your income or what you do for work. We really look at the purchase price, the rehab budget, the ARV, the timeline, your credit score, experience, and assets, right? Most of these loans got to be able to, you got to be able to show that you have money. You got to have liquid tangibility. You just can't, borrow money from a parent and say, hey, I want to do this. Like you got to show some things. They have to close in an LLC. These are business purpose loans. This is why we could do them in all the states. All right. We don't have any regulations on that. We want to be, so that's one piece. The other piece is the draw schedule. So, if you need money for a project or to put an order for specialized windows, they'll cover upfront like 25% of the deposit. Like there's a whole bunch of things that go into this. And everything needs to be inspected with pictures, or if it's a major thing with a local inspector. And, once those are completed, you upload your pictures, the draw requests come in, you move on and you just keep doing it. So the nice thing too is, obviously in these, there's no principal needed. It's interest only while the work is happening. And the main reason why investors use these loans is simple. They allow you to leverage capital instead of tying up all your cash. I don't understand why people are doing these type of loans with cash and then tying it all up. It doesn't make sense. If you're buying a $300,000 house, you could probably do 2 or 3 of these simultaneously at the same time and triple your income. So 3x it, right? So that's why I always tell people, who cares about the rate? And most of the time, if it's a good deal, it's built into the whole deal. So you don't even have to worry about it. But that's the biggest thing, is keeping money on hand so you can scale. That's the key. So once the project starts, it's all about the execution. You got to make sure you stay within the budget. Of course, if you come less than budget, that only helps you. On schedule, because you have a certain timeline, right? The faster you do it, the more money you make. The longer you take it, the less money you make. And then making smart design decisions. So before the project's even finished, we're already thinking about the exit plan. Like we got to start thinking about, are we selling the property? Is the price going to be right? What's the time of the market? Are we going to refi cash out as to pay off that loan and then you keep it as a rental, whatever it might be, right? But these are all the things that go into play with it. You got to have an exit strategy always. Um, so, the goal is simple. You sell it, close clean, and walk away with strong margins. You go on to the next deal. So the flip isn't finished when the renovation ends. It's finished when it sells. That's the key. So if you're done in 3 months, well, all right, well, now you could say you got about 10 months, no, not even 8 months to sell the property. You got to get it gone, right? So those are all different things when it comes to that. So what I want to show you real quick is I want to show you a sample here. So if you are watching this, great, you're going to see it. If you are listening, I'll read through it. So let me share my screen here real quick, and I'm going to show you a letter of intent on a deal here. So a property here in Florida, we're looking at a 650 purchase price and a total construction budget of 250,000. Okay. So with that being said, is when you start looking at things, and you're going to see a lot of things on this piece of paper, like the loan amount, you're going to see the rehab construction holdback, the interest rate, the term, which is how many months, the interest reserves and what those look like. And then you're going to see your minimum loan payment per month and your max. So those are based on the draws. But the biggest thing here is the LTARV, right? So that is the after repair value. So in this deal here, we're at 59.25%. Okay. That gives us a lot of margins up to the 70%. So for example, if the contract doesn't get locked in at 650, well, 700 will be no problem. Okay. Or 725. So these are all factors that we look at. This is just a letter of intent. Like, hey, this deal looks good. It's been verified. We want to move forward with it. All right. Now, the other piece here is because the ARV is so low, those interest payments. So that's the reserve, 51,500 is built into the deal. So my client doesn't have to make any payments. I think it's up to 9 months. All right. So if you get in and get out before 9 months, you're making no payments. All you're doing is putting your cash needed to close, which is, called $196,617, and call it a day. And the rest of them are the closing costs, which some of them they could roll into. So I think this is a freaking awesome deal. I think this is a really good thing for clients out there that are looking to get into this. And I'm encouraging people to start looking at these options. Stop using your own money. You could do 3, 4, 5, 10x what you're doing when you leverage your money. All right. So that's kind of it in a big nutshell. I just wanted to get the information out there because I'm diving into this huge. Of course, I still do all the normal loans and all that good stuff, but I like to have niches. I like to do things that other people do not do. That's why I highly recommend, if you're a realtor out there and we haven't worked together, let's partner up. I basically do every single thing possible out there except for brand new primary construction. Like I could do lot loans up to, as low as 150,000. I just don't do the construction loans. All right. For primary homes. For investors, yes. So these are options that are going to help you make more money and be more prominent in your market when you're farming and talking to people as a real estate agent. Also, if you're an investor out there, this is a way for you to scale up and make more money. All these things are great. Yes, there's closing costs. Okay. You're going to have closing costs no matter what. Are you going to spend a little bit more? Sure. But I don't care how high the closing costs are, unless they're 100%, which they are obviously not. It is allowing you to grow and scale your business. And that's how you win. It's not rocket science. It really is not. I can't tell you how many people I talk to that are in the fix and flips. They use their own money and then they want to try to go these crazy avenues to get more money because they paid cash. Stop paying cash. Leverage it as long as you can, right? If you got a good plan in place, you shouldn't care. You shouldn't care about the interest. Well, first of all, if your deal's good enough, you're not going to pay anything. So I want to leave you with this. Fix and flip investing isn't about taking risks. It's about understanding the process, running the numbers, and working with the right people. With prices adjusting and opportunities opening up, this is one of the best times in years to learn how this works, even if you're not ready to pull the trigger yet. So if you're looking at a property and want to know if it's a real opportunity or just looks like one, that's where our conversation starts. The best flips start with good decisions long before demolition day. So, with that being said, if you have a scenario out there or you've been thinking about this, reach out to me at any time. You could reach out to me on Instagram, Facebook, email, matt at anchorhl.com, my cell phone, 239-666-5005. You could reach out to me at a bazillion ways. All right. But if you are getting excited about getting into these type of deals, let's talk. All we need is a property address. Go in the chat GPT, get a construction plan, put everything together. All I have to do is send an email out, take a look at it, have a questionnaire filled out, make sure your credit's good. That's always important in this world, your credit scores. If you have crappy credit, it's going to be really hard to do things and you're going to be a cash person. But those are the things you got to look about. And the escrow holdbacks, I'll tell you, the first one might take 72 hours because you got to get set up in the system. But after that, they fly. All right. They're released and fly. They want you to get the in and out. That's the key for all of them. Nobody wants to hold their money up. The lender doesn't want to hold their money up. These are all things that come into play here. And it's all going to be good. This is all good stuff. So, again, if you're interested in learning more about this stuff, reach out to me. I am the president and owner of Anchor Home Loans LLC and Iron Gate Lending LLC for Tennessee and Texas. Let's figure out how we can get more business, being smart about it, right? And not using our cash, not borrowing money from people. Let's just do it the right way, make it happen. So thank you so much. I am excited to be back. I will have more content coming out over the next couple weeks. We are going to be doing our episode number 2 with Mike and James. So Real Talk Gone Wild. So stay tuned for that. And make sure, as always, if you can, hit me a like, subscribe, share. I appreciate it. And I want to just keep continuing to educate everybody out there so more people understand all the different things you could do. So I'm signing off. It's Matt. Talk to you guys later.